Hello, chart watchers, and welcome to this Wednesday, April 10th, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, after a couple days profit taking, we do have a mixed market today. You can see the Dow Jones Industrial Average currently down 10 points. The S&P 500, however, up 7, and the NASDAQ up 38. The Russell 2000 up 13, leading on a relative basis. 10-year Treasury yield starting to roll back over again at that 20-day moving average, currently down 2 basis points, 2.48%. Volatility index has been on the rise the last few days, but still overall, we're in the lower end of a range over the past couple of months. Technology leading to the upside. Semiconductors, one of the big reasons. You can see the semiconductor group almost up 1% today. This has been a really strong area of technology in 2019, and they continue to lead. The four top stocks in the S&P 500, you can see here on the screen: Conagra Brands, Holly Frontier, Xilinx, and Fortinet. A couple of these you can see breaking out, especially Xilinx and Fortinet above some key highs. Well, Erin, it is hump day, another week half over. We are less than 24 hours away now from the Masters.
Well, the hockey playoffs start tonight, so I get started on my first love.
Yeah, we're going to have a little battle here. You know, definitely hockey starts. I'm into it. My Capitals won the Stanley Cup last year. They start tomorrow night, so I'm into it. But they're all going on hold for 4 days. Everything in my life goes on hold for the next 4 days during the match. Can't wait to get things started there tomorrow. But we do have a show here, and we got a very special guest with us today. We have Tony Dwyer, who manages Dwyer Strategy at Canaccord Genuity. I know many of you may have seen Tony. He's been on CNBC. We are certainly glad to have him with us today. Tony, how are you doing this morning?
Doing great, Tom. Thanks for having me.
Well, thank you for being here. I know I saw an appearance that you had back in late December on CNBC where you did talk about the stock market and how you thought we might have one more pullback, but that you were very bullish. And I kind of carried that same thought. I thought maybe we'd go back and have a double bottom, which we never got. So I'm assuming you're probably going to have a discussion today talking a little bit about this bull market. Is that correct?
Yeah, that's for sure. That's for sure.
Where are you calling in from?
I'm currently in Ramsey, New Jersey, northern Bergen County in New Jersey, right on the New York State border.
Okay, so you're not far from Wall Street.
No, I'm usually in Midtown Manhattan at 54th and Madison in the Canaccord main office there in New York.
Okay, well, we're certainly pleased to have you with us today. We can't wait for your presentation. So if you can stick around for about 15 minutes, we'll bring you in, and I'm sure all of our viewers would love to hear what you have to say as well.
You bet. Excited to do it.
All right. Well, let's go ahead and get into the schedule and the agenda for today, Erin.
All righty, let's do that. Tomorrow we have Roman Bogomazov. He is going to talk Wyckoff, so you'll want to tune in for that. Next week, Tom McClellan is going to be here on Wednesday. And on Thursday, Julius DeKempener will be there, actually helping me co-host. So should be a fun week. But today is even better right now, of course. We have our guest, Tony Dwyer, here. And then after that, we're going to do our 10 and 10. And our first symbol is going to be United Rentals. And then finally, we will finish out the show with chart breakouts. All right, Tom, let's get started.
All right, let's get into some of the economic reports. We did have an inflation report out earlier today. That was the CPI. So the CPI came in for March at 0.4%. You can see a little hotter than expected, but the core CPI actually was a little bit below expectations, rising just 0.1% versus the 0.2 that was expected. Later today, we've got a lot of bond market traders and a lot of stock traders as well. Will be sitting on the edge of their seats waiting for the FOMC minutes to be released at 2 o'clock. So don't be surprised if you see a knee-jerk reaction one way or the other after traders get their hands on that or on those minutes. But let's take a look what's going on in the Treasury market. You can see we have started to roll over here on the 10-year Treasury yield. We've been in this downtrend. It has not really spooked the stock market. The stock market's continued to go higher, even though we have seen Treasury yields moving lower over the course of the past 4 or 5 months. If we do eventually see this reversal in the yields, we start moving higher, that would be a pretty good signal because it would indicate money rotating away from those defensive treasuries. As far as some of the earnings reports out today, we had Delta Airlines coming in better than expected, but we did get a little bit of a miss from MSC Industrial. So kind of a mixed bag there, where we got one solid report, one not so good. And let's take a look at those charts. And by the way, we do have a number of earnings beginning to roll in here, the balance of this week and into next week. We're going to see things really start to pick up. So you want to stay tuned to Market Watchers Live so that you can keep your finger right on the pulse of earnings season. Here is Delta Airlines. Now, we did get the gap up today. Delta reported revenues that came in slightly better than expected. We did have revenues that were $10.47 billion. The market was looking for $10.41 billion. Bottom line, 96 cents versus 89 cents. And then they guided in line going forward. They got the gap up, but still got to get through that December high. So technically got some issues here, but short term, nice breakout to open April above the double top from February and March. Volume came in on that move. So it appears that we're getting some accumulation by maybe perhaps some institutions. The problem I have with Delta is not so much Delta, it's the airline group. So airlines have not yet cleared the February high. Part of that could be the fact that we've had crude oil prices surging. But until we get that breakout, I think we could still run into trouble, because here on this bottom chart, you can see airlines relative to the S&P 500 during 2019, not so good. And so the problem with Delta, even though Delta has been one of the better airline stocks, and you can see the group or the stock breaking out relative to its group, the problem isn't so much with Delta, it's the overall group. So based on that, I'd like to see this absolute breakout above $61. On a pullback, I'd want to see the area around 54, 54 and a half hold as support on Delta. The other stock that I mentioned that reported earnings is MSC Industrial Direct. Now, this is a different story in that we, first of all, came up with a revenue number that was below expectations, $823 million versus $826.2 million expected. Bottom line, $1.24 versus $1.26. And then they guided their Q3 earnings per share lower. So this is a trifecta, but the wrong kind of trifecta. Missing top line, missing bottom line, lowering guidance. You can see the stock down 5% today. But once again, if you follow relative strength, you probably could have seen this coming. The industrial supplier group, you can see overall from an absolute basis doing okay this year. But notice down here at the bottom, on a relative basis, the group is not broken out versus the S&P. Probably about the best I could say is it's just kind of going along for the ride. But so you've got a not so exciting group, the industrial suppliers, and then you can see MSM relative to the industrial suppliers has been declining for 6 months. So this is not a stock that Wall Street has really been looking at positively. And so when I see that, I don't look very positively at the stock either. And so when we get the report that comes out and they miss on their top line, miss on their bottom line, warn going forward, we shouldn't be too surprised. Now, technically from here, we have a double top in play around $86. I think that's a level that we need to really watch closely. To the downside, that March low we want to watch. If we fail to hold there at 78, then I think we've got a much better shot to move back down close to that December low at 72. And again, think about how far the market's come since that December low. This stock is up less than 10% now from that December low, which is way below what the overall market has done. So not a very good stock here. All right, a couple other individual stocks. Let's take a look at First Solar. First Solar had their target raised from 64 to 75 this morning at Goldman Sachs. And Goldman Sachs also added the stock to their conviction buy list. Volume is definitely pouring into the stock. We've now seen north of 2.5 million shares already today. Still another 35 minutes to go before we get to the halfway point of the session. So we're looking at the possibility of maybe 4.5, 5 million shares traded today, which would be the strongest volume day of the year and probably the strongest volume day since at least last October. on this breakout. So I think that First Solar is looking pretty good here. Note also that we had a straight move down back in June on heavy volume, and all of these reaction highs, we really struggled at about $55, $56 dating back close to a year. So the fact that we're now breaking above with this kind of volume, I think we have a pretty good chance to head up to about the 65 level, which was prior support. That now becomes resistance. So watch for 65 on First Solar. AMD, they also had their target raised this morning to 33 at Cohen. And this is part of the semiconductor group that I mentioned top of the show has been very strong. Here you can see what this group has done since that December low. We were down below 2,700. Now we're above 3,600. So that's probably about a 33% climb since the December low. I think since the beginning of January, the group is up about 25 or 26%. So it's been a huge move in the semiconductors. And what we are seeing is relative strength. So it's not just absolute strength, but semiconductors are getting more than their fair share of money rotating into the various industry groups. And when we look at AMD, yes, AMD struggled for about a month and a half last year, but we have started to show relative strength in AMD relative to its semiconductor peers. So AMD, I think, is looking pretty good here. I think not only on an absolute basis, clearly we have an uptrend in play, but I think on a relative basis as well, I think you've got one of the leaders here in AMD. Disney, talked about this one yesterday, got upgraded yesterday, got upgraded again today. Stock did gap up earlier. I think we've got some overhead resistance. We need to negotiate at 118. But after a straight move up these past 2 or 3 weeks, I think Walt Disney looks pretty good, maybe just pulling back from being a little overbought. Check out the Broadcasting and Entertainment Index, though. This is a group making a breakout to the upside, taking out the 2018 highs. I think that is a good sign. Disney, while it hasn't been a great performer on a relative basis in 2019, has started to pick up steam, and the group overall has been a pretty good group relative to the S&P over the last year. So I think if we get this breakout above 118 on Disney, this is a stock we want to keep an eye on. LYFT, Lyft, remember they just recently came out with their IPO? Stock has been under a lot of pressure. It actually needs a lift, technically on its chart. Stock opened near $88 the first day. Remember, it had been priced at 72. So traders really excited, but came back down, really struggling, breaking to a new low today. And in just a few weeks, in actually maybe a month or so, we are anticipating Uber's IPO. So don't know what's going on here. Let's see if we get a reversal, because we did try to break out above gap resistance. You can see that failure. That led to selling. Maybe we leave a long tail to the downside and come back up and hold this area around 66, 67, perhaps put in a short-term support, but volume is picking up. So let's see where we close today. A breakdown would not be good. A reversal could perhaps put in a short-term bottom. Okay, Erin, it is time for upgrades and downgrades, so I'm going to turn it over to you.
All right, excellent. Let's see what we got here. Okay, well, we're going to get started with our upgrades, and the first one is going to be Exelon Corp, EXC. This one was upgraded today by Goldman from a sell to a neutral. So we're moving up on our expectations, but not into the buy. So just something to consider. We did start getting a breakout today in the short term from a declining tops trend line. I'm not expecting much. If we get to $51, I think that would be a good thing, but I'm not so sure we're going to get there. And certainly if we do, I wouldn't look for the breakout, mainly because I have PMO sell signal. We're not really seeing any deceleration yet on the PMO, even with a move to the upside and intraday high. I would like to see more out of the PMO as well. Volume is, the OBV is declining with price. So again, I'm not really thinking too bullishly about Exelon despite the upgrade, but it is up to a neutral, not a buy. Next one up is Gilead Sciences. GILD was upgraded today by UBS from a neutral to a buy. I like this one. Right now, I think the big problem for it is getting through this declining tops trend line. We tested it this week, or actually it looks like on Friday, of last week. So we were able to get to the top of this rising trend channel. And notice when we came down to that low, it held above the 50-day EMA. 20 has now crossed above the 50-day EMA, and that's an intermediate term trend model buy signal for decision point. So I think this one's looking pretty good. I would expect to see Gilead move higher. There is, of course, the risk that it will come back down and test the bottom of this rising trend channel. So something to keep in mind if we come back down and start looking like we're going to test that 20-day EMA. All right, so let's go to the next one, Realogy Holdings, RLGY. And this was upgraded by Compass Point from a sell to a neutral. Let's see, they have a price target around $12.50, but it looks like, of course, we've hit that, currently trading above that. Like the rounded bottom here on the price, you've got the PMO buy signal, but something to keep in mind, it looks like it's going to come up and test that $14 overhead resistance. But remember, we have a 50-day EMA with a lot of margin below its 200-day EMA. So thinking bullish expectations isn't always the best thing to do, because this particular stock, RLGY, you can see the declining trend it has been in. So there's a lot of downside pressure here. So maybe you'll get up to 14, but I wouldn't be looking for a breakout just yet. I know the PMO looks pretty good, but again, seeing that 50 so far below the 200 does have me concerned. All right, let's move on to some downgrades. Apple was actually downgraded today by HSBC from a hold to a reduce. So this is really moving into a bearish stance right now, and they have moved their price target to 180 down here at that 200-day EMA. You did just get the 50-200-day positive crossover, so that technically does put Apple into a bull market configuration here. We do have rising momentum. It's in a rising trend channel. You know, I think Apple still looks pretty good, but yes, 210 is going to be a difficult spot. And if we do come back, we're going to come up, and I would almost guarantee we're going to see the top of this trend channel and 210 coincide, and that's going to make it very difficult for price to get above that area. We are looking a little overbought on the PMO. Herbalife was downgraded today by Argus from a buy to a hold. Clearly, investors are in agreement on this downgrade, as price is already down almost 1.25%. PMO has turned down below its signal line. It looks like it had already started to decelerate yesterday with that drop that we saw. You know, OBV is topped out here, much lower than previous tops. So, you know, I would be looking for a test down here at support around $51. At that point, I would reevaluate, see if we can't get the PMO starting to decelerate and turn up. That might be the area to consider getting into this one. But right now, I have to say I agree with that downgrade. B of A Merrill downgraded Liberty Global, LBTYA, and they downgraded it from a neutral to an underperform, and with their price target at $23.50. So they're looking all the way down here below the support of $24 and the $24.50 we saw back here from March. And well, from March, you can see the OBV is trying to travel higher. You know, it did come in with two tops, the second top being above the previous, and that's in line with what's going on here. So volume is, the OBV at least, is telling you that this move is, to the upside is confirmed. You know, maybe we're forming a little bit of a flag here on a flagpole. So I have the PMO buy signal. The scooter has turned down, but it's still fairly healthy. So I'm not so sure about this downgrade, but we will certainly see in the coming weeks as to whether that particular area is going to hold, and certainly that 24.50 if we do break down. All right, and that's it for the upgrades and downgrades. Here's the listing. A couple of interesting upgrades to consider. The Cerner was upgraded. Disney was upgraded today for the second day in a row. And you can notice also Baidu, Foot Locker, Novartis. Those were other downgrades that I did not cover. All right. Well, it is time to bring in our guest, Tony Dwyer. Tony is from dwyerstrategy.com at Canaccord Genuity. And Tony joined Canaccord following the acquisition of Collins in March of 2012. And you're currently serving as the head of the U.S. Macro Group, chief market strategist, and a member of the Canaccord U.S. Operating Committee as well. So I'm very interested in seeing your presentation, Tony.
Well, thank you very much, Erin. I really appreciate it. Do you see it up there?
I do.
That is so excellent. So Tom and Erin, thanks for the opportunity. And Tom, just quickly to kind of give the audience a little bit of history here. So we had expected, and we actually did a CNBC special about a correction call in late September, early October. We did two different things. I never expected a 20% market event. I expected a typical pullback. The algos took over, the structure of the markets, different now with the Volcker rule, all that fun stuff. So I never expected a 20% decline, but it was ripe for a correction and an increase in volatility. Back then in September, you had a VIX at 9, you had investors intelligence newsletter writers were 62% bullish. You just had this environment that was ripe for it. We're not there now, but so what happened is down by the December low, as you guys know, and Tom, you mentioned, every single technical indicator you could find had hit a historic extreme, whether it was sentiment, the stochastics. Like on Christmas Eve, I follow the weekly stochastic on the S&P 500, 14-week stochastic with a 3 smooth. It has never in its history closed at 0, and it was at 0. So it closed below 5, and it was literally at 1. So the market was ripe for a reflex rally, which typically when you get that oversold, it's about 14% in what we call a crash environment, which is any drop of 17% in 3 months or less. So the bottom line is you had this environment in September that was ripe for a pullback, not 20%. And then it got so extreme in December was ripe for a reflex rally. What changed the call that both of us thought would happen, which would be kind of a double bottom, a test of the low, was the thrust indicators, right? Like the breadth thrust indicators were extraordinary in early January at 90% upside volume days. The Lowry's folks, point that stuff out. You just had this kind of Jason Goford, sentiment traders, mentioned a lot of the sentiment things had kind of had this reflex that created a breadth thrust and a thrust in the market. And that's why we changed from thinking that you were going to get a test of the low to kind of a giddy up and go environment. So the theme that I would like to hit on now is the 3 things that people are focused on, that the yield curve inversion in bonds are telling us something. Number 2, that the global growth slowdown is bad. And number 3, that there's an earnings recession that's going to drag stocks down given the reflex rally. In other words, it's just still a reflex rally and it's not fundamentally driven. So here at Canaccord Genuity, we have a core fundamental thesis. And the core fundamental thesis, Tom, you mentioned inflation this morning. It's driven by inflation. But I've been doing this a while and I'm really good at being wrong. So what I try to do is follow the things that aren't wrong. And I know that the market correlates with the direction of earnings. The direction of earnings drives economic activity. Economic activity drives the slope of the yield curve and availability of money. That's driven by Fed policy and that's driven by core inflation. So the core inflation actually has been a pretty good indicator of this is just to show you guys the backup. I'll never say something that I can't put in a chart because otherwise I'm making it up. You should be able to show it on a picture. If you see a lot of written text from me, I'm making stuff up. So here the correlation you can see is in 0.946 of the direction of earnings to the S&P price itself. So it's driven by core inflation. I like to joke with people, you don't have to be a master economist to look at this chart and know that inflation's low. Not only is it low historically, it's actually turning lower recently. And that was made true of the core CPI this morning, which is at 2%, down from 2.4% in 2018. So what gives the Fed room? President Trump put a lot of pressure on the Fed. People are focused on that. what gave the Fed the opportunity to pivot on this dovish pivot was the fact that core inflation had peaked out and started to come down, especially when you look at the 5-year inflation break even. You hear Fed Chair Powell talk all the time about how they look at what the market expectations of inflation are. Well, here's what the 5-year expectations are, that in 5 years, inflation will be at 1.81%, right? If you look at prior cycles, it's below where it was in 2005, well below where it was in 2005. It's even below where it was in 2018. So between the core inflation rolling over and the 5-year inflation break even not showing any kind of real problems, it gave the Fed an opportunity to do a dovish pivot. Average hourly earnings are in an uptrend, but again, similar to inflation expectations, average hourly earnings are still below where they were last cycle. So I'm really hard pressed to say that the Fed is actually going to be worried about inflation when, think about this, guys. You've had every monetary authority in the world has printed money for years now. The U.S. is at absolute full employment, with the unemployment rate being below where it's been in the past. It's at a historic low, and you can't get inflation above 2%. You know, if you're the Fed, you're a lot more worried about disinflation than inflation, which is why we think they're going to actually cut rates later this year. So page 6, this page is a great one because it's the real Fed funds rate. It's the real Fed funds rate using what the Fed uses, the core PCE. Now, what you see is 4 arrows there. And you'll notice that every economic cycle, the peak in the real Fed funds rate is lower. You know why that is? You know, I won't make you guess. It's because there's more debt. You cannot fix debt with exponentially more debt. The more debt you have, the less of an interest rate increase you can take before you get into delinquency and then defaulting on that debt. So each cycle has brought with it an increased use of leverage. That increased use of leverage has caused a lower real Fed funds rate. So on to the bank lending practices. So we have low inflation. We have an easy Fed. Neutral rate is 0, right? So the Fed is neutral. And you actually have banks willing to lend. Now, this might be too much information, guys, but, you know, on Christmas Eve, I'm home, I'm sitting in the hot tub, and I'm trying to figure out what the heck is going on. I got a market collapsing, but none of the credit market indicators like this one were scary. So I called the bank CEO and I asked him, what do you think, you know, what's the backdrop of lending? Bank CEO said to me, is a friend of mine, said to me, I don't get it, Tony. I can't lend enough. I want to lend more. I need more demand because all the demand is going to the shadow bankers. So no, non-traditional lending. It's hard to have a credit crisis when banks are trying to lend more money. You can have a credit panic. We kind of had that, but you can't have a credit crisis when banks are still willing to lend. And what really drives that is this chart, which I call the mother of all charts. You can see that this is the spread between the 2-year and 10-year yield curve. Now, there's a monster debate going on about this because the 3-month 10-year inverted, the 1-year 10-year inverted, but the 2-year 10-year did not invert. And it's an important point. Here's why. The 3-month and 10-year yield curve is what, or the 1-year 10-year, is what makes banks lend. So if you were a bank and you got your money at 4%, would you lend it at 3%? Of course not. You'd lose money. That's why the yield curve is important for banking. It's not a market indicator as much as it is a money availability indicator, right? So if banks are getting their money more expensively than they can lend it, they're just going to stop lending. That's like common sense 101. That inverted, which tells you need more than a couple of days, which we got, but the 210 did not invert. And the reason that I used and focus on the 210 now is because so much more of lending is being done in the non-traditional bank lending market, which is not funded by a deposit base. Quicken Loans, the Rocket Mortgage, doesn't have a deposit base that they can take and lever into loans and use for loans like a bank does. So they got to go out and get the money. Typically, they get it at 2 years. So if something like 50% of mortgage lending is done in non-traditional bank lending, like a Rocket Mortgage or a Navy Credit Union, how do they get their funding? Well, they get it on the 210 spread. But let's say, just for giggles, the 210 spread inverts in the next 15 minutes. all of a sudden it just goes, bonkers. It's actually historically a buy signal. And forget about whether it should be or shouldn't be. Let's get over that. Look at what it is. The table's right there. You get a median gain to the peak of the cycle of 21% over 18 and a half months, with a recession starting 19 months later. If you just look at the last 3 cycles, which are more similar to the current low inflation, high leverage cycles, you had a 34% median gain over 22 months, with a recession not taking place for a little over 2 years away. So to say that the yield curve inverted 2 weeks ago, even if it, which it didn't on the 210, but let's say it did, it's a buy signal. It's not a sell signal. All you got to do is look at the data. There's only one negative data point there, and that was 1973, when you had a heck of a lot more going on than we currently do. So low inflation, easy Fed, yield curves given money availability for banking and shadow banking, and non-financial corporations can afford it. Look at the bottom half of this slide. The interest coverage ratio is well above mean. I'll just ask you guys or anybody that'll listen to me, what makes you stop spending money? Well, you don't have any, right? Or you can't afford your mortgage and all your disposable payments are going to credit cards or whatever. Companies have cash flow and interest coverage ratios still well above mean, which means even though they are way highly levered, they can still afford the debt. And therein lies the real rub. I'm friends with all the kind of, I don't want to call them perma bears, but the more bearish ilk among us, because I've been in their camp. I'm in their camp, and I'll be as bearish as I've been bullish for the last 10 years when credit is not affordable and it shuts down. Companies have too much debt. That is not up for debate. There's no way this ends well. But the statement kills so many portfolio managers or investors because they invest in, quote unquote, this won't end well, years before they should. And that is exactly what's going on. There's too much corporate leverage, but they can afford it, right? As you can see here, that's also reinforced by the bottom slide, which is high yield debt to treasury spreads are trending back toward their low. You can see on the top half, that blue line is the Barclays high yield corporate bond yield has come down, as has the treasury yield. Where you got to worry about this is when treasury yields are tanking and corporate yields are spiking. Just simply not the case right now. So when you look at the bond market, you know how in at the end of last year and into early part of this year, people were saying the bond market's telling you something, right? It's quote unquote telling you something because that top half, you've seen such a drawdown in bond yields for the 10-year. Well, you got to be careful when you say that and make sure that you got to figure out which bond market is telling you something. Because the top half is a treasury bond, which people are telling you you're going to a recession or near it. The bottom half is Barclays U.S. Corporate High Yield Total Return Index. And it'll call me crazy. That kind of looks like an uptrend to me. It's made a new high. It's making new highs every day. So be careful to think that the bond market's telling you something in isolation. You have to look at all the overall areas of credit. And this is my favorite checks and balances. I wake up, I think a lot of people probably think I wake up every morning and figure out how to be bullish. But I wake up every morning trying to figure out where I'm wrong and why I'm wrong. And on page 12, this is the checks and balances to all my other credit-related stuff. This is the Chicago Fed National Financial Condition Subindices. You can get them. Go to the Chicago Fed website. You can track it yourself. You don't need my chart. I'd love it if you want to subscribe to dwyerstrategy.com, or if you're an institution, call our desk. But the bottom line is you can get it from the Chicago Fed. It measures 105 indicators, credit stress indicators. So the way I figure it is if it is different this time, or if there's something in credit that I don't know about or I can't hear about from other people, surely it's going to show up somewhere in 105 indicators that measure credit stress in banking, shadow banking, and the financial markets. You can see what was going on in December. Nothing. There was nothing going on in December. There was nothing going on in 2016. A little bit of problems in 2011, but even then, you didn't get anywhere near where you've been at the recession level. So I think it's an important thing to have a checks and balances chart. Now, from a growth perspective, let's talk about this for a second. I think we're in like a 1995 scenario, and if you think you remember what 1995 was like, you better go to the library and microfiche some of the articles because you can't pull them off the internet. You know, there was no Barron's Business Week. They didn't archive things before the Wall Street Journal. They have not archived things and put them on digital prior to mid-1997. So the net of it is, I went to the library, I microfiched all the Barron's and Business Weeks, and what I found was in 1994, the Fed doubled rates. They almost drove the economy into a recession. You got the yield curve down to 7 basis points. The growth, you went from very strong growth, even through the first, 3 payroll reports of 1995. You got really good growth, but the Fed was starting to worry about housing, autos. So they made their last rate hike in February of 1995. And by the way, 1994, you had 2 10% pullbacks, one in February, one in December, very similar to this past year. Anyway, bottom line is the Fed went from tightening in February of 1994 to cutting interest rates in July of February of 1995. They actually cut interest rates less than 6 months later in July of 1995. The reason that's important is, trust me when I tell you, if you go back and read the Fed minutes from 1995, in February, March, April, there was nobody saying on the Fed, wow, this is really tanking, we need to cut rates. Market goes up 20% for the year by the July rate cut in 1995. Clinton was being sued by Paula Jones. The Whitewater investigation was taking place. So what his way to deflect that was he created a potential trade war with the second largest global economy, Japan, which was about the same size as China's economy for global GDP today. So you had a Fed that had to pivot. You had the market up 20%. You had the Fed cut rates, even though people early in the year thought they were going to hike them. Sounds kind of like a bad setup. Well, the market kept going up, as you know, into really the 1998 peak. When you look at this chart in front of you, look at the 90s, you can see that there were 2 quarters in a row that were at less than 1% growth. Those were the first 2 quarters of 1995. So the point is, I got to move my little text box, but that's right to the right of where that 3.2 is on the screen, on the top half of that screen. So you had an environment where you almost shut down credit, but you didn't. The market was ripping. The Fed cut rates. And by the way, they cut rates in December after the market was up an additional 15%. Okay, so what's another checks and balance? We're not near a recession. This is the ISM Manufacturing Optimism Index, which has shown that over the history of this index, you have a recession from the date you make a peak, the cycle peak, which you could call last August, 31.5 months before your next recession. You can see that up into this last month, you had a drop in some of the ISM services, non-manufacturing components, but that made the new orders and business activity made a new high 2 months ago. And this is the Small Business Optimism Index, which leads the recession. Its cycle peak leads the recession by 41 months. So I got the yield curve telling you it's going to be 2 years. I got the ISM telling you it's going to be almost 3 years. I got the NFIB small business telling you it's going to be almost 4 years. I'm having a hell of a time saying that we're going to have a recession in 2019 or even 2020. So what I'd like to talk about a little bit is housing. Right? How does the economy grow? I think people forget the stimulative effect of the long-term interest rates coming from 3.25 down to 2.60 in this most recent move. What you have is the home ownership trend on the bottom part of this slide 19 is coming up from historically low levels, and it's being driven by the millennials. Right? You can see the millennial demographic. The peak birth year is 1990. That means, I don't know, just ask, I could ask you guys and you could ask anybody, if you have a millennial in your household, do they know anybody going to a wedding this year? Most of them would kind of chuckle and say, yeah, somewhere between 5 and 10 of them. The millennial demographic was not unique to any other demographic. I like to say that I was a millennial. You know, when I was 25 years old, living in New York City with 2 of my buddies from college, wasn't thinking about having a mortgage or 2 car leases. Fast forward to when I had 2 kids, one and one on the way, out to the burbs we go. Very similar to what's happening with the millennial demographic whose peak birth year is turning 30. So we got banks that are willing to, inflation is allowing the Fed to keep interest rates low enough, and banks have money availability and are easing their lending standard, have easier lending standards still. So I have low inflation, easy monetary policy in theory, low interest rate environment. I get a demographic tailwind that is pushing housing in the U.S. by the home ownership rate going up. This graph on the left side is the global manufacturing purchasing managers indices. Green is good, red is bad. You can tell most of the world is green outside of Europe. Comes as no great shock. Global services PMIs on the right are the same kind of thing, where most of it's green. And what we have is a lot of people are talking about the global growth being in a bad spot because you have such weakness. The IMF lowered their growth expectations last year. Just look at this chart, guys. Breadth of manufacturing purchasing managers indices globally. When was the time to get cautious? It was in the very end of 2017. That's your time to worry about global growth. Time to worry about global growth is not when this number is below 20, and it sure as hell isn't when the share of PMI's new export orders on the bottom are near zero. That's when you want to start thinking about a turn. So what's the sign that you could have a global turn? I was on CNBC the other day doing the closing bell, and they looked at me like I had 10 heads 3 weeks ago when I said that there's signs of a global inflection. Do you ever notice that the second derivative is only talked about when it's negative? When you have a peak reading and it's turning over, like in the beginning of 2008, nobody ever talks about the second derivative when it's actually turning up from a wicked low level. And that's what we're seeing on the OECD leading indicators that measures 36 global economies. And what you're seeing in the middle chart that you inflected a few months ago on the month-to-month data, on the CLIs posting monthly positive changes. And if you look at that, that turns before you turn the year-to-year changes on the bottom or the overall index on the top. So I'm throwing a ton at you. But the point is, you got low inflation, easy Fed, still positive yield curve, which is incentivized lending, a demographic tailwind. Global growth has already been beaten up. It's not the time to get negative there. So how do you have what's an earnings recession? What causes an earnings recession is a drop in the price of oil historically. A non-recession earnings compression comes from a drop in the price of oil. That has been more than recovered. To give you an idea, since we're starting earnings season later this week, in the next couple of days with the big banks reporting, what's interesting there is in 2016, 15 and 16, when you had the last earnings recession, it came with negative revenues and negative earnings. Revenues, according to IBIS, should be up 5% this quarter. So instead of revenue, top line growth, it's going to be up 5%. The current consensus is calling for a 2% drop in actual earnings, S&P operating profits. Historically, through this cycle, you've not had a single quarter where the number that started the earnings season, which would have been April 1st, has not been revised up by the time that the last company reports, with a median gain of 3.5%. So what that basically tells you is if the current number is -2, the end result should be plus 1.5 if it hits the median. 80% of the time, the increase in the number from the first day of the reporting season is over 2%. So it should be, you've got huge odds of not seeing an earnings recession actually having a positive number for Q1. So I think that's a really interesting time to be able just to show you the backup to that. There's the backup to that on page 32 of the slide deck here. You can see that the fourth quarter of 18, you had a 1.1% differential, and you can see the data. It's pretty consistent. It's very consistently positive. So when you look at what all that means, you've had a multiple compression because the market crash, non-recession market crash in the fourth quarter. So here you can see that trailing 12 PE has dropped from over 20 down to, I think it's like 17 now. The interesting thing is when you look at it historically, when core inflation is between 1 and 3%, you traditionally get your average multiple is 19 times. So not only is it not a stretch because you were there for 2 of the last 3 years, but that's your number. So if you get a target of, a year out, call it 19 times. Our number's 168. It's somewhere north of where we are today. And just lastly, I would like to just remind everybody, don't focus on somebody's target. I'm like the poster child for this. The reason is you're trying to pick the right point in time and the right valuation. Focus on the process like I just walked through versus what a target is. You know, this is a bull tape still. I don't think it shouldn't change. Could it pull back a little bit? Hell yeah, it could. We're up straight up almost 25%. You've had some, you know, a few technical divergences, new highs, things like that. But I can't find any data that suggests that once you get this breadth thrust, that you have a tank later in the year. So, Tom and Erin, I kind of went on too long probably, and I went real quick, but I wanted to get it in there, and I can take any questions.
Well, I can tell you right now, my head is spinning.
Yeah, I bet. Mine is too.
In a good way, in a very good way. I thought the presentation was excellent. I think actually it's probably one of the best presentations we've had here on Market Watchers Live, being totally honest, and not just because you're bullish, but I think the arguments that you made and the information that you shared, I think was spectacular. So really appreciate the presentation. And I will go back and go through this presentation one more time, because there you threw a lot at everyone, but you got a lot of arguments backed up by facts. So very good presentation. Really enjoyed it, Tony.
Thank you.
Okay, couple of questions here. One, and I think you covered this a little bit. Some of the questions came in, and then you continued doing your presentation. So I think you may have covered some of this. But if you're looking at our economic cycle right now in the U.S., where do you see us still in the early stages? I mean, do you think this goes on for quite a while? I know you said you don't like to try and give targets and that sort of thing, but do you think we're still like in the fourth inning of a 9-inning game, or do you think this is seventh or eighth inning?
All right, so this is kind of an interesting question, because if you think about it, let's go back. I'm going to take you back to a chart that'll answer the question. Like, if anybody ever answers these questions without giving you data, you should short them. Okay, you see this chart here with the real Fed funds rate? Mm-hmm. You see in the last 3 cycles, Tom, they've been longer each time at the lower level of the real Fed funds rate. Mm-hmm. Right. So in the 1990s, you were only there for like a year and a half at the low and negative rate. Then in 2002 to 2005, and now you did it from 2009 to 2016, almost 2017. In other words, the amount of leverage that we're having is making the cycle be extended, because it takes you longer to dig out from the crisis. Mm-hmm. Right. Once you go into a credit crisis. So the innings, we were in the early innings of the game for 7 years. And we're in the middle innings now, where the Fed is raising rates to the point where they're going to invert the curve. Once they invert the curve is when you go into the later innings. We've yet to invert the curve. So I would say economically, we're towards the later part of the game. But the first part of the game was like they batted around the order 4 times.
Mm-hmm. Yep, I got it. All right, I've got a question for you. And you know, you talked a lot about the 10-year Treasury yield and the 2-year Treasury yield and the spread there. And of course, when I was before I got in, you know, started working in technical analysis and dealing a lot with the stock market, I'm a CPA, so I audited companies. I actually worked a lot with banks, so I was following a little bit what you were saying. And of course, as this spread between the 10-year and the 2-year continues to dwindle, that's not usually a good thing for banks, their bottom line, because their net interest margins are shrinking and so forth. So given the backdrop in what you're seeing with the 10-year Treasury yield and the fact that we're now getting close to that zero line, the 10-year looking, you know, versus the 2-year, do you think, looking ahead, that this is an opportunity? And I'm not talking about any individual stocks. I'm just talking about the group of banks. Do you think that because they have outperformed during this whole period, really the last year or so, with the 10-year Treasury yield dropping versus the 2-year Treasury yield, do you think this is an environment where banks might make sense?
Well, and maybe one of the worst calls in my career, I've been overweight banks for a while. But yeah, I do. And the reason is I go back to that 1995 analog, and what kick-started banks was some M&A. We just recently had BB&T was acquired. They were a merger. So you had the same kind of thing in the early part of 1995. And again, what had happened back then is the Fed got the curve to about 7 basis points on the same exact reasons, Tom. You had the 10-year and the 2-year dropping, but the 10-year was dropping more at that time. Once that stabilized and reversed, which I think we're doing now, banks outperformed basically until 1998. So you still had a pretty good performance. So I would stay with the banks. I'm overweight the banks.
Okay.
I think one of the problems that I missed in this cycle, that I think a lot of us missed about the financials and the banks, is I don't think it's as much yield curve driven. I think lending is being more impacted by shadow banking competition. You didn't have the rocket mortgage in past cycles.
Mm-hmm. Good point. Very good point. All right. I got one more question for you, and I'm going to let you go. I'm going to pull up on my screen here. I've got a chart here of the U.S. dollar, and you didn't talk a whole lot about the dollar. But, you know, back in 95 to 2000, we had a very strong bull market with a rising dollar. In 2002 to 2007, we had a bull market where we had a falling dollar. Over the past 10 years, we're now back into an environment where we're seeing the dollar rising. My question, just from a macro perspective, how much attention do you pay to the dollar, number one? And if you do recognize that we're in an uptrend here, how is that impacting your portfolio as far as like which areas of the market you favor?
So it's a great question. If you look at the dollar, at the U.S. dollar on this chart, you notice one thing. It hasn't changed a bit since the end of 2014.
Mm-hmm.
Like I don't necessarily know if it's as much as an uptrend as you're consolidating that spike. So I frankly don't know which way to go. I would have said that you broke that out in late 2016, which totally failed. Then you totally broke it down in 2017, and that failed. I don't know what this chart's telling me. I got a big fat neutral on it. So I think right now, until it really has a significant move one way or another through the top end of that range or through the bottom end of that range, I think it's one of those great media-driven, overblown calls that I'm not willing to make, because it is literally unchanged over the course of the last 4 years, right?
Mm-hmm. Well, I know, you know, we've been in an environment, for instance, in energy with crude oil prices surging again. But yet when you look at the energy ETF, the XLE, relative to the S&P 500, it's actually been going down, even though crude oil prices have been going up. And of course, one of the things providing those headwinds has been this uptrend in the dollar since 2011. So I was kind of looking to see maybe if there was any areas maybe that you would rule out until we see a definitive break to the downside in the dollar. But it sounds to me like you're still just kind of neutral.
I'm just kind of new, but think about this too, about, you know, it's interesting because if you move your trend line and you just make for the range, it really, like I said, it hasn't moved really in 4 years. So I think the underperformance relative to the price of oil, I'm wondering if you wanted oil exposure, you used to have to buy an oil company. Now you can buy an oil ETF, correct?
Right.
Remember when gold stocks, gold was ripping and people were flabbergasted because the gold stocks weren't playing the game as well? And then I was thinking, well, maybe it's the gold ETFs. If you want gold, why would you take company risk? So I think that that's having an influence on some of the commodities that we didn't have in prior cycles.
Very good. Very good. Well, it has been a pleasure having you on the show. I know our viewers certainly enjoyed this. I did. And like I said, I'm going to go back and review it again. So thank you so much for joining us today on Market Watchers Live. We hope you'll come back and join us sometime.
I sure will. Have a great day, and thanks for the opportunity. Take care.
All right. Thank you, Tony. Okay, that was a great presentation. I really enjoyed it because it, like he said, there was a lot backed up with facts. It wasn't just, hey, you know, take my word for it kind of a thing. And it wasn't just one piece of data. It was a lot of different angles going in. I mean, I could have talked to him a lot more, because I also think that the employment, the jobs and all has a pretty important impact, but didn't want to keep him too long. We're going to get him back though, for sure. Right, Erin?
Oh, absolutely. No, it was very interesting to get that macro view.
Absolutely. Okay.
Let's do this. 10 and 10.
Yep. You got an RRG?
Yes, I do, as a matter of fact. Not a huge amount of requests. And like I said, I always know we have an interesting guest when we don't get as many requests as usual. Interestingly, energy and healthcare are the leading requests. So I thought that was very interesting. And we do seem to have a little bit of everything going on as far as the RRG is concerned. So let's go ahead and get started with URI.
All right. I'm just going to say blanket no to the energy stocks. I'm not kidding.
Okay.
I'm not a big fan of energy, as you know, and anybody watching the show knows, just mostly because of the dollar. As long as that dollar continues to rise, I've just seen enough evidence technically on the charts that when the dollar's in a move to the upside, energy and materials tend to underperform. So I'll stick with that until I get that breakdown. But anyway, here on URI, I'm not a fan. I mean, we had a nice little uptrend going in January and February, but you can see we are well off. We're down probably close to 15% where we were in February, yet the overall market's been going up. The peer group that it's in has been going up. So I don't really know what I could say here to make this one look good. I mean, we just need to see a reversal. You can see URI relative to its peers continuing to trend lower, relative to the S&P continuing to trend lower. And yet the overall group, especially here in 2019, this has been a really strong group. So you've got a weak stock. Until we get a breakout and start to show relative strength in the stock, I would pass on it.
All righty. The most popular in the chat room, interestingly enough, is CPG.TO. And of course, that's also in the energy space, but an oil and gas producer.
Yeah. All right. Okay. Well, first, I like the breakout. If you're just simply looking for a technical reason to buy, that breakout was it. Not only was it a breakout, but the volume picked up. I think you've got potentially a bottoming head and shoulder pattern here, reversing head and shoulder. Here is your left shoulder. There's your neckline. Lower low puts in the head. You come right back up, test this area, pull back one more time into a right shoulder and get the breakout. You can see the volume pick up to 20 million or almost 20 million on that move. Now, would I chase it here after it's already up, 15% from the breakout level? I would not personally. I just think there's too much short-term risk. Longer term, this might be a great play. So if you're a long-term investor, maybe it does make sense. But as a short-term trader, I want to try to get it as close to a key support level as I can. So pull back here down to about 465, 470. I would like that quite a bit, because then I can manage my risk to the downside a little bit better. So I know I said earlier I wouldn't like any oil and energy, but there I liked one.
All right, there we go. Let's see. The next one up is going to be INSP, Inspire Medical Systems.
Yeah, I kind of like this one. I especially like it if it can get back up through that 20-day today, because it has been struggling at the 20-day recently. I'm looking back. There was a breakout, that was a top. We got the breakout, good volume. We came back down just a little bit below, and you can see that reaction low came down to about this 51 area. We went just below it here recently, but the volume started to dwindle on some of these moves to the downside. We actually came back up, left tails to the downside. So I actually think in the short term, this stock is range bound between about 51 and 58. But I think the overall pattern here is up. So I'm looking for this to return back to the upside. A breakout above 58, I think, would be really big here.
Okay. How about, this was actually my Monday setup, but a lot of interest in it. Sunrun. Yeah,
Run definitely having a great day. Pulled back yesterday, but held that rising 20-day moving average. I think this one looks good. Beautiful move up to start the year. We pulled back. You could, I'll draw a little bullish wedge here. Whenever I use do patterns, I always use the black coloring. But here you can see the tops, and then you can see the bottoms. And you see that kind of forming into that piece of pie. And notice when we broke to the upside, look at the volume, just a little bit of an increase, but definitely a tick to the upside. So I think this is looking like we want to go back up and challenge that recent high. So I would say there is your candle body, close to 16.5. Intraday 17, a little over 17. So I would look for this stock to make a run there. I think off of this uptrend, another thing that maybe you could look at here would be a possible cup that is forming. Not quite there yet, but you can see that rounded bottom starting to form. So I think this one's got a really good shot to move back up close to that 17 level. I think this is and it is part of the renewable energy space, which has been so strong. So I think there are several reasons to like this one.
All right. Let's see. Next one is CNQ, Canadian Resources.
All right. Another one making a breakout here recently. I like that. I would have liked a little bit more volume on the breakout. Tried so many times. You got gap resistance. See it right? Now, let me pull it back just a little bit. Right there. See this gap and the heavier volume here on the selling? Notice when we go back up, big volume. We had the breakout intraday. We failed. Come back up here, 2 more breakouts, we fail. Another possible breakout, we fail. Now we finally get through, and I'm looking at it. The volume's just kind of so-so. So good news is you got the breakout, and now you should have price support at 28.5. The bad news is I would have liked to have seen some more volume on that breakout. So if you come back down and you can't hold this area of support, price support 28.5, rising 20-day moving average 28.12, that would be a red flag to me, because I don't like low volume breakouts and then failures to hold those breakouts. So that's something to kind of watch and keep in mind. But hey, got the price breakout, which is half the battle. Now let's see if we can hold on any pullback.
All right, sounds good. Let's see. Next one up is going to be, we haven't looked at this before, FTCH. I think I got that in here.
Yeah. Oh, Farfetch. Yeah, I actually like this one. I think it's getting close to gap support. It had a huge move up. It's on my strong earnings chart list, but you can see right here was a prior high. We failed to make a close above there, and then just below that is your gap support right here from the earnings that came out the open March. But look at where we are now. We're back down here challenging gap support, price support, 50-day moving average. This was a stock 6 weeks ago that was over 31. Now you can get it just under 25. I like it here, and I would keep maybe a closing stop below the 50-day moving average. But I think this is a nice looking chart.
All right, excellent. How about, and it's a favorite of mine, Williams and Sonoma. Not necessarily the price chart, but certainly enjoy the wine.
This one I think is still kind of, wrestling with overhead gap resistance. You can see the big gap down. This was back in November on heavy volume. Where did we fail? Came back down. Where did we fail? Came back down. Where did we fail? Came back down. Here we got a little bit of a breakout, but volume did pick up a little bit, which was good. But on this false breakout coming back down, I'd really want to hold this rising 20-day moving average. I'll give it down to the 20-day, but below that, I'd be careful because, again, this was a huge area of resistance. If we start to break down, I would be a little bit more cautious.
All righty. Let's see. Next one, Intuitive Surgical, ISRG.
Yeah, this is one that reports pretty early in earnings season, so you want to keep an eye out. I think they report next week sometime. But I love the stock. I'm going to go back into the relative chart here. So you can see it's made a huge run off that December bottom. Medical equipment has made a huge run, and this stock, Intuitive Surgical, starting to strengthen again pretty significantly relative to its group. So there's a lot to like here. I do like the fact that we are getting through 580, but the volume is not really confirming here. One positive, though, is I think this is a very strong part of the market. You can see when we go through a period of relative weakness and we start to turn back up, that has in the past led to more relative strength. And I think that's where we are right now. So if I was annotating this, one thing that I certainly would pay attention to is that relative strength in the industry group and the fact that we have been strengthening now for quite some time. And so that gives me a little bit better feeling about the overall stock. I would say this, if it does fail to hold this breakout area right around 580, it has been pretty strong just about every time it's come back down and tested that 20-day moving average. So that is something I would watch for on any pullback.
All righty. Let's see. Next one up is TTMI.
All right, TTMI.
Electrical components.
Okay, well, it's trying to make a breakout. That's the good news. Its group already has made the breakout. So what you're looking at, you can see on this relative strength line, it's not exciting. It's not when you look at the overall group, it's just kind of been flat versus the S&P. And there's been a lot of relative weakness leading up to 2019 for the stock relative to its peers. And we're just kind of going sideways here. I think it's kind of a boring stock for me. So I think it's got to make number one a breakout here. And I'd actually draw this line a little bit higher. I think we could go to the gap resistance. This is where we were before we gapped down on this heavy volume. Then we could even go to the reaction high after the gap down. So I'm going to say this is a key zone, 13 to 13.5 for the stock. For me to get more interested in it, what I want to see is heavy volume breakout. And when I come back down, I shouldn't have to try and figure out whether or not the stock is rising relative to its peers. We should see a big move to the upside. That could be the change in character signal that we're looking for here on the chart. Until I see that, I think there's just way more interesting candidates out there in other areas of the market.
All righty, let's see. Next one up, and actually our last one is NVIDIA. It's NVTA. NVIDIA.
Oh, NVTA.
Yes.
All right.
Biotech in a while?
No, it's in a nice little cup pattern. It's one of the better biotechs. I mean, if you look at the stock relative to the biotechs. So really what you're waiting for is simply the biotechs to start to move relative to the overall market. Now, because the biotechs have been weak, what I tend to focus on, if I do trade a stock in a weak group, I don't want to make excuses if it starts to break down. So I think you got to pick your line in the sand for NVTA, and I would stick with it. I'd rather be wrong and have the stock go up than to be wrong and follow the stock all the way back down in an underperforming group. So I think that the recent low here around 22, I don't want to see it go below that level. I think the other thing that I'd be looking for here is that the stock is in a nice little cup pattern off of its uptrend. So there is your high. There is the recent low. See that nice little cup off of an uptrend? So I think you could maybe go sideways here back to the 20-day. A breakout above 26 would actually measure up to about 31. I like the stock. I like the volume coming in. I think it's clearly one of the leaders in biotech. Don't really know the company too well, so I'm assuming it's a smaller company. But just beware that biotechs are not really in favor. That would be my biggest concern here.
All right, and that does complete the 10 and 10. Here are the symbols that Tom just annotated. If you would like a copy of all of those charts or one or two of them, just go to the MarketWatchers live blog. You'll find it under the articles tab. Click on that, and the link to that live chart list with these will be right there at the top. All right, time for our final market update. All right, here we go. Well, the Dow is the only laggard. It's down 0.06%, not too far. Maybe we'll get it to pop back up into positive territory like it was earlier today. S&P 500 rising, but it looks like we're starting to consolidate, maybe pull back from those intraday highs. NASDAQ is pulling back from its intraday highs. Look at mid-cap, still moving to the upside. Looks like the acceleration is slowing just a wee bit, but certainly looking better than some of those large cap indexes. And look at the Russell 2000 making a nice move to the upside, up almost 1% today. TSX, Canadian markets, are up on the day after gapping. And you can see that it's up 0.35%. So pretty good day for the Canadian markets, the TSX. Treasury yields down slightly here at 2.469%. VIX is also moving lower. We're now under a reading of 14, currently 1387. UUP, we had a nice opening, but have been pulling back ever since on the dollar. Currently, it is reading 25.94. GLD has been on a nice steady uptrend all day long. Gold looking good. Currently, GLD at 123.75. USO making a nice rise after testing yesterday's close. And we can see TLT big gap up, but consolidating sideways, currently reading 124.38. As far as sectors go, leading sector is the energy sector, up almost 0.7%. Technology is right behind that at 0.44% gain. And our laggard is utilities and materials, which actually had a pretty good day yesterday, pulling back. And that's all I have for our final market update.
Okay, I wanted to take a look quickly at the gambling stocks. First of all, you can see we had a nice rally in January and February in the group. We pulled back. We're below that 20-day moving average for a few weeks. And now we've gone back up and moved back through not only the moving averages, but we've taken out that February high. So this is a group, you can see the PPO's really strengthened. I think this is a group that's beginning to show some leadership characteristics and an area maybe to consider as we go into the second quarter. I think maybe we're going to start to see some improvement in some of those earnings. The other thing I wanted to show you just on an RRG is the group relative to the S&P 500. And this is what I was talking about in terms of starting to show some nice leadership. If we go back to where we were in the bottom when we first began this rally back in late December, you can see that this group started to strengthen initially and then went through a period of just kind of lagging, weakening, and we're in that lagging sector just a couple of weeks ago. And now, literally over the course of the past 2 or 3 weeks, has just shot up from lagging into leading very, very quickly. So we're starting to see money rotate. I think this is just an area maybe we want to keep an eye on as we go forward. All right, we're going to go into our final segment of the day, and this is our chart breakouts. Of course, we've had a very, very fertile market for chart breakouts, a lot of movement to the upside in 2019. So, Erin, I'm going to let you start. What do you have for the breakouts today?
I will do that. I'm going to actually start off by looking at my scan, of course, since I always love to do that. All right. So today I decided to go, and go ahead and take that poll because we will talk about it afterwards. But I decided to start off with, first of all, I always like to get a U.S. stock. I mean, that's what I'm looking for. So I always put that to start off. And then I like to have an average daily volume above 80,000, I would say at least. And then what I wanted to look at were those making new 52-week highs. And so that's what we have here. And generally, of course, if you're doing that, you're going to be breaking out. And then to narrow the field, because I just did this and it came up with like 180 or something stocks, I don't want to be sorting through that. So I decided I wanted to look at one that had a PMO that was actually less than the signal line. So it hadn't had the positive crossover just yet. And then I wanted the PMO line to be greater than yesterday. So I wanted it to be rising in the very least. So, all right. So that's what I did to get to my stocks that I wanted to look at. And I came up with about 6 that I thought I would share with you. I've annotated some. We'll annotate a few together. All right. So first off, I want to start with an ETF. It's the only one of the ones that I've done. And this is the DNP Select Income Fund. And as you can see, we did get a breakout today. Of course, price has now pulled back. And generally, that's what I like to see. I like the breakouts, and then I like to get in on the pullback. This one, I would want to see a little more of a breakout. Now, of course, earlier this morning when I was looking at these, it was actually trading near the intraday high, but now it has pulled back. But you can see a nice rising trend that it's been in. We might just have to test that one more time before getting up there and breaking out to the upside, but certainly making the attempt. And as you can see, rising bottoms on the OBV as well as on price. So I always like to see that. And the scooter is just about in the hot zone. It did pull back just a wee bit. All right, Gray Television was another one that came up for me. There's that PMO. It isn't above the signal line just yet, so we don't have a buy signal, but you can see it has been rising, and I would say that's a breakout. So I like the looks of that, but pretty much I am not one to necessarily trade on breakouts, and that because I really need to wait for the pullback. We always talk about not wanting to chase. This would be one of those times for me. It's up almost 5.5% today. I would be looking for a pullback and seeing that the PMO continues to move its way upward even on that pullback. But, wow, decisive breakout to the upside. I would expect more upside movement, but maybe a pause at least before getting in there. All right, next one I had up Okay, you can see an itty bitty tiny breakout going on right now for Mettler Toledo. This is a medical equipment industry stock. It's in a rising trend, and I like, of course, that we're getting ready to pop above that, near testing the top of this rising trend channel. And of course, beating out that recent high is great. And if I recall, I go look at this a little more closely here. Come back here for me. I want to use my handy dandy shortcut here, but I think if we look at the weekly chart, it is continuing to make all-time highs. And notice, I know on an intermediate term basis, I think this one still looks really pretty good here. All right, let's go to Pegasystems. Very clever name there. And as you can see, we are getting a breakout, really a nice short-term breakout from this pennant that you can see in the thumbnail. So your symmetrical triangles, like this one is, pennant formation, those typically resolve in the direction of the current trend, which in this case was up, and we did get that breakout. PMO is trying to turn back up. Of course, we had a fake out back here at the end of March. So I'd be a little bit leery of that particular move to the upside. But we do have this nice scooter. It's really performing well amongst its peers. And, you know, OBV is still looking, yeah, it's looking healthy here. I certainly, if we close on a high, hope that this volume picks up a little bit, because on a breakout, I would like to see more than this, even midday like we're at. All righty. Xilinx, and I know we've talked about this one for a while, Tom. I think this was, well, it's been one of your Monday setups. I don't think it's this week's, but nice looking. Got a breakout from an ascending triangle. I'm going to annotate that for you so you can get a better idea of what it is. You could start with the rising trend here if you wanted, but the tops that I'm mainly interested in are right here. So that is what we would call an ascending triangle. I would probably, just to make this a little more consistent for me, I'm just really picky about my chart patterns. Okay, so ascending triangle, rising bottoms and flat top, and that is a bullish pattern. We got the breakout. The PMO is trying very hard to turn up and give us a buy signal. I like that it has flattened out on this move. I would have like to see it really spike to the upside, but we'll have to see what happens at the end of the day. But a nice move on this breakout. I like it. All right, and then I just have one more, Tom. I'm going to pass it to you. And the last one is Zebra Technologies. And I feel like we've looked at this one. I think this was a 10 and 10, but it happened to come up on my scan. Really, probably one of the better PMO setups that I've seen on the charts so far. You know, you have it in somewhat overbought territory, I guess, if you want to look back here. But it's getting that nice move to the upside. Looks like we're going to have a nice clean crossover on this breakout that actually began 2 days ago. So on Monday, we've got a nice scooter. Look at the OBV. It's just been rising gently the whole time, confirming this rally going to the upside. If we look at the weekly chart here, and there you go, making all-time highs still. And you can see PMO buy signal still intact, and we're moving higher. So I do like Zebra Technologies right now. Again, watching for the problem of chasing. This is what I wanted to see. You know, we had it Monday, the breakout, and then it came back. That's the bar. That's where I would normally get in. So this one is a little bit of a late comer. All right, Tom, what do you have?
Okay, I'm going to start off. And first of all, when I look at these chart breakouts, some of them are just making breakouts. Some of them are already made breakouts and have pulled back, and others might be on the verge. So a lot of different looks at it. But let's start with Fortinet, FTNT. I think this one's pretty clear. We got a triple top coming across here, February, March, early April. We've been holding the lows, if anything, maybe rising lows, so a little bit of an ascending triangle here. And this breakout is for real if it holds into the close. Volume's been picking up, and we're just a little past the halfway point of the day. So we're probably looking at about 3 million shares today, which when you look back is a heavy volume day. So I think this breakout's being confirmed, assuming that we close near the high of the day. We don't want to go back near the low of the day. That would be a false breakout, long tail to the upside. That would make me a little nervous in the short term. But a close here, I think, would confirm the breakout. So FTNT, definitely a chart breakout for me. SYMC, this is Symantec. We talked about this one earlier this week. They did get an upgrade earlier in the week, made the breakout, and now they're coming back down. And I actually like today's low, coming back in and challenging the support area at about 23.5. So 2 days ago with the upgrade, and I don't like to chase, stock was up to about 24.75 or so. Now we've pulled back about 5 or 6%, gotten close to that area of the breakout. I think that combined with gap support around 23, I think represents a couple of good areas to get in. Symantec also in that software space, which has been so strong. Speaking of software, you might have heard of this company before, Microsoft. Off of a nice uptrend, very strong move in the middle part of March. We really consolidated. I see a little bit of a cup with a handle. And as we go into this handle, you can see volume has just been kind of light, which is a classic cup with handle formation. Breakout above 120, 121, I think is going to measure up to about 125, 126. And I fully expect that we're going to see that eventually on Microsoft. So I think Microsoft looks good. Stock I put in my blog this morning, GWW. I'm going to actually stretch this one out a little bit. Not yet interested in the company, but I do think that this area of resistance is important. So the industrial suppliers struggled yesterday, and you can see GWW led that move to the downside. But I think it's pretty clear off of the selling we saw in October, we had one reaction high that came up to about 319. Here you can see we got up to 320. Here maybe 317. And again, just earlier, well, actually at the end of last week, near that 320 level again. So this is one that could be setting up for a breakout. I would not trade it until I saw the breakout. But this was a stock, if we go back a couple years, was very, very strong and went through a rough patch. You can see, look at that huge move. This could turn out to be just more sideways consolidation before we make another break to the upside. That's why I think 320 is important. So we don't have a chart breakout yet, but this is one I might keep on a list for possible chart breakouts going forward. JetBlue, same thing. I think JetBlue now has been downtrending for quite a while, but off of the most recent downtrend, I see what could be off of this downtrend, a left shoulder, neckline, head, neckline, right shoulder, and now we're moving back up. So here you've got a stock that's been downtrending for 15 months, and yet we're still talking about a possible chart breakout. Well, with patterns, you can have a breakout even though you're in a downtrending stock. So I just wanted to point that out. This is not one of my favorite stocks. In fact, if we pull up a relative chart here, you're going to see that not only have airlines struggled, but JetBlue has been one of the worst airline stocks. So I'm not trying to necessarily make a bullish argument, just pointing out that breakouts can come in all kinds of different colors and sizes. Baidu. We'll just go ahead and leave it here on the relative chart. Pull up Baidu. Now, Baidu was downtrending for a while, and you can see relative to the internet stocks, it was downtrending. Although maybe it's starting to turn back up again. We'll have to see whether or not we can put in a higher low and then a higher high. But internet stocks, we've talked about really strengthening into the end of the year and the first month or two of 2019. Sideways consolidating. Look to see if we get a relative breakout. If we do, just know that Baidu has made a breakout here above about 176. The rising 20-day moving average comes in at 173. This is one that has been a laggard. So if it fails, if it comes down and can't hold that rising 20, I'd get out quickly. But if it holds and the internet stocks continue to lead and Baidu, let's say this is the start of something much bigger to the upside, you could be getting in pretty early into a rise in Baidu. So thought this one was worth mentioning. COG, we got a few more. I'm going to go through these really quickly. Cabot Oil and Gas, I think the breakout here above that March high, pretty obvious, but we now go back to the November high. Need to make a breakout there. DE, this is Deere. Caterpillar hasn't been nearly as strong as Deere, but notice Deere holding support. This is an uptrend, sideways consolidation. So a stock maybe to consider on this pullback would be Deere. Keep a fairly tight stop, close below 155, and look ultimately for a chart breakout above about 166, 167. Twitter, another one in the internet space. Just like Baidu, I think, on a relative basis, not one of the best stocks. You can see it has started to outperform, though. So if we could get a relative breakout, I'm going to say 37, 37 and a half ultimately is where I want to get a breakout on Twitter. This is one maybe to keep an eye on. Lockheed Martin, double top here, just above 310. Want to get a breakout above there. We did have a rise into the end of February, pullback hit the 50. Look for a possible breakout here. And then the last one, United Technologies, UTX, did just get a breakout above multiple highs at about 130. I liked it. The volume picked up on that move to the upside. For in the aerospace area, which has been downtrending, this is actually a stock that is starting to show a lot of relative strength. So if as long as aerospace doesn't get dragged down too far by Boeing, I would watch price support. But I think this rising 20-day and price support around 130 is interesting on United Technologies. All right, that is a wrap. Let's go ahead and go over the charts that we just pulled up. You can see the stocks that Erin had there, stocks that I just went over, and we are at the end of another day. I do want to pull up the poll, though, and just see whether you all like to trade chart breakouts. And everybody, decides chart breakouts, on their own. They have other, their own definitions. I went through some that were in clear downtrends that could potentially still be considered a breakout. I actually am going with the majority of this group, Erin. I'm going with no.
I'm going with no as well, just because I like to find them maybe, but I wouldn't trade them until I see a pullback, or, if it's going to still run, I'm not interested in it. But the problem with chart breakouts is generally you're looking at stocks that have already kind of done their thing. And so you really want to wait for that pullback. I mean, that's what I like to do. If they don't ever pull back for a while, I will. But so I would say no, just because I don't find it and then go right for it.
Yeah, I would be in that same camp, and for the most part, for the same reason. I just don't like to chase. So unless I'm catching it just as it's making a breakout and I see that volume coming in, normally I won't chase a breakout. But I do like to trade stocks that make a breakout and then pull back, like you said.
Exactly. And I think that most people feel that way.
Yeah.
Well, clearly 53% do.
Well, about half of them feel that way.
Yes.
All right. Well, certainly appreciate everybody being with us. I thought that presentation today, again, by Tony Dwyer was excellent. If you came in late, you might want to go to YouTube, check that out, or listen to the replay of the show later today. There you can see our upcoming schedule. I want to thank all of you for being with us. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.
So in the book itself, just so everybody knows, it's all stock charts. It's all stock charts setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in stock charts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.